Let's go to our last slide, the thought provoker in focus. What's in focus today?
Well, really, what we wanted to have a look at here was what the reaction had been to Friday's job data. Bonds have had their move, but equities seem to be hesitant. So the chart here plots the US 10-year note against the S&P 500, the bond in the blue and the index in green. And as we can see, US 10-year bonds have moved, as we might expect them to, in the light of the 70% chance of a December rate rise following Friday's outside payroll gains. And obviously the move has been that bond prices have fallen and yields have risen. US equities, though, have posted a muted response, though it's fair to say that both financials and the regional bank sector have moved higher in the US. So the question is, are US equities pausing for thought, or did October's rally leave little room for upside manoeuvre here? And then further from that, will the benefits of an improving US economy be outweighed by rising interest rates? And that really sort of throws up a question about the pace of any Fed rate rises. You know, would December be a one-off event, or would we see a rapid escalation? So we need to think about that. In terms of what the market might be thinking, I think it could be very interesting to watch the consumer discretionary sector, because obviously if rates rise, perhaps people's incomes will be pinched. You know, they've got to pay off the debts that they've got, or at least fund them at a higher level. So perhaps watch that sector. XLY in the US is a highly liquid ETF on the consumer discretionary sector, so it may be an idea to keep an eye on that. It's early days. You know, we literally, realistically, you know, not even 36 hours in market terms after the you know, that news on payrolls, and so there's a lot to digest. But there's, you know, the gut feeling is that equities shouldn't do so well in a rising interest rate environment.